welcome to our webinar on ELSS. My name is Sandeep Bhosle. I take care of the customer interaction team at Quantum Mutual Fund. Thank you to all of you for joining on today evening. With us, we have Sorbh Gupta. Sorbh Gupta is the fund manager for Equity. Sorbh brings around a rich experience of 15 years in the research. Today, we will have a brief presentation on how ELSS can help you in saving tax, and also it can be a wealth creator. We will also go through how ELSS can help you in a quantum approach of 12-20-80. So we'll have Sorbh who will be giving us a small presentation on ELSS. The presentation will be around 25 to 30 minutes. We will have all the question and answers after that. This webinar, we would specifically like to be around the questions for tax saving. So any questions you have, you can please put forward and write in the chat box. We will try to answer all the questions. If not that, we'll surely get back to you. Over to you, Sorbh.
Thank you, Sandeep, and welcome everyone for this presentation. The topic, as you know, is ELSS. So we will have a presentation on ELSS, a presentation about how we go about tax planning, a bit of tax planning, bit of choosing products within the tax planning part, and within that, why ELSS could be helpful in terms of tax and wealth creation, and how to choose a good ELSS. And we'll also have a few slides on the characteristics of quantum tax saving fund. While I understand that there will be a lot of questions on how the market is behaving in last 1 or 2 days or maybe a week, and all these geopolitical tensions and the impact is being felt across portfolios. So I think definitely there will be questions. So for the presentation part, we will stick to ELSS things. But post that, we'll open up for question and answers, and whatever doubts in terms of whatever you have in terms of how the market will shape up and how could this geopolitical risk impact your portfolios, your funds, and how are we prepared, how are we thinking about that. All the questions that you may have, I and Sandeep will take care of that as part of Q&A once the presentation is over. So I'll be there till the last of the questions are getting answered. So with that, I'll just start off with the presentation, which will take 20-25 minutes. Post that, we'll have Q&A, as I said. So clearly, this is the tax saving season. While we have been telling people that you should start your tax planning since April, not to start from December when you receive first HR mail about submitting the tax proofs and other things. But nevertheless, most people still pursue their tax planning and manage their cash flows in Jan, Feb, March. So tax planning, especially under ATC and other things, are getting more and more important. Now, what the government is doing is that for last 7-8 years, the slabs have not increased. So on nominal basis, if your income is increasing, but inflation is also increasing, but the slab is not increasing, net, your tax on the real income is going high. So it is very, very important that we use all the available tools in the Income Tax Act to save tax and create wealth. So broadly, if you talk about Section 80C of the IT Act, which provides 1,50,000 rupees of investment allowance, which gets reduced from your total income. So 3 broad categories where we can put our money over there. One is clearly market-linked schemes like ELSS and ULIP. ELSS stands for Equity Linked Savings Scheme, and ULIP is a equity plus insurance kind of product. Then you have a plethora of fixed income products, which is PPF, NSC, tax saving FDs, post office time deposits, NABARD bonds, senior citizen savings schemes, and so on. Others are more of where you have expense, but government allows you to take benefit of that expense. For example, NPS schemes or child's tuition that you pay. Repayment of housing loan is one amount that people use quite often. So there are 3 broad categories. Now, we will talk of the first 2. Expense part, I'm sure you guys can take care of that. The first 2, where investment in equity plus or fixed income. So we thought we'll talk with you about 4 filters or 4 lenses to choose the right product within this gamut of ATC. One is definitely the return potential of the product. Return is extremely important with inflation moving up and down. And India is historically an inflation heavy country. So return potential is extremely important because we need to generate real returns. Second is tax incidence. Somehow the government has different taxations for different products. It's not streamlined. So tax incidence also becomes important for your return at the end of the day. minimum lock-in period. Now, all these products have lock-in period because government wants you to invest somewhere where you don't pull out money quickly and it goes into long-term savings, which helps the nation as well, right? So the idea is to put the money in long-term, but different products, again, will have different lock-in periods. So that is an important criteria for you to look at. And then comes the compatibility to long-term financial goals. So every investments that you do should be mapped to your financial goals. It's extremely important. I'll explain that in a few of the slides, and where you map that long-term investments, and that with that framework, you will achieve your financial goals. So these are the 4 key things that you should look at while choosing the right product. Now, coming one by one, return potential of ELSS is higher, but not guaranteed. So we are here giving different rate of returns that people can get pre-tax. So ELSS is clearly market linked, right? But if you go back in history, which SEBI does not allow me to put a number, ELSS is a category in last 3 years has given a return of close to 17% CAGR. If you go back 7 years, it's given a return of close to 11.5% CAGR. And if you go back 10 years, it's given a return of 12% CAGR. So very decent returns from ELSS. NSC, again, it's a 6.8% kind of return product. Tax saver, bank FD. Bank FDs have been under pressure because yields going down. So 5.25 to 6.6% kind of return. And fixed income, within fixed income, PPF is one which gives you the most handsome returns. Otherwise, they are kind of mid-single digits to a slight above that. So these are the return profiles of different products when we look at it. Now, coming to the tax rate part of it. Now, again, the tax rates are different. So when we look at ELSS, till 2018 January budget, it was tax-free. Post that, subject to grandfathering in January 31st, 2018, you have long-term capital gains tax of 10% above 1 lakh capital gains. And this is without indexation. NSC is taxable as per investors' tax slabs. So there are different segments of income and taxes are as per the tax slab. So if maximum marginal tax rate, excluding the surcharge, is close to 30%. So once you have that 30%, just a moment. Yeah. So once you have that 30% slab, your tax rates would be close to that level. PPF is totally exempt for taxation. From taxation perspective, PPF clearly stands out. NPS is partially taxable, depending upon when you are withdrawing, how you are withdrawing. And ULIP again is taxable at the rate of 10% if your annual premium is 2.5 lakhs or more. Tax saving FD again is as per the income tax slab of every person. So if you look at tax saving FD and NSC, clearly they have the highest tax incidence, more than 30% if you include surcharge. 30% is the maximum marginal tax rate. Anybody going to that threshold, they have the highest tax incidence. Lowest is PPF and ELSS is somewhere in the middle. Now, investment period, if you look at ELSS, the lock-in period is 3 years, and which is the lowest. NSC is close to 5 years, PPF is 5 years, NPS is pretty long term. ULIP is again 5 years, and tax saving FD is 5 years. So ELSS clearly stands out with just 3-year lock-in period. Coming to why ELSS. Now, when I was talking about those 3 filters that you should use, it clearly stands out in terms of the return potential and in terms of the lock-in period. It clearly stands out. Now, ELSS is a perfect combination of tax saving and capital appreciation. Now, let me give you an example over it before I read through the points. Now, let us assume you have 1,50,000 of rupees to invest in ATC, which is the maximum that you can invest, which is allowed as a reduction from your total income, and you are in the highest income tax slab. Right? So once you invest 1,50,000 rupees, assuming that the tax rate is 30%, excluding surcharge, immediately you get a tax saving of 45,000 rupees. Right? So you save taxes of 45,000 rupees. So your net investment that you're doing is 1,05,000 rupees, despite putting in 1,50,000 rupees. Now let us assume that you generate a return of 12%, which has been a 10-year CAGR return. Let us take a longer term period. Let's not take a 3-year period. At 12% rate, 1,50,000 rupees will become 2,10,000 rupees for what you have invested. Your effective investment is 1,05,000 rupees because you have saved 45,000 rupees. At 12%, you get after 3 years 2,10,000 rupees. So effectively, in 3 years, your money has doubled, right? This is an extremely important point because because you save upfront, your effective returns that you are generating is very, very attractive. This will happen in all the products, but definitely because the return potential of ELSS is higher, the most impactful is this within ELSS. So that becomes extremely important. 3-year lock-in is lowest. After 3 years, you have freedom to put your money anywhere you want. Though we advise that you should map these ELSS product to your financial goals and keep it for a long time, right? So equity returns or equity behaves like an asset class only after 3 years. So 3 years is a minimum, but we would always advise that keep that money for longer periods of time. It's extremely well suited for long-term goals such as child education and retirement planning. So if you're looking at say 20-year period, 25-year period of investment and that compounding of 11-12%, while actually diversified equities have given you better returns, but 12-15, even if you assume a 12% return, the compounding potential is extremely good. And longer you stay in equity products, the more safer they become. So we did an analysis over longer periods of time. And what we saw is that if you have held Sensex for any period of 7 years, what you will see is that you don't lose money, right? So that is extremely important. So any period rolling return of 7 years is not negative from a Sensex perspective. So longer the period, safer your return becomes. There could be volatility, there could be standard deviations, but loss of capital risk reduces as you increase your investment horizon in equities. Yeah. So now the moot question here is that what to look for an ELSS scheme, right? Because, and this question becomes paramount of a paramount importance because it's a product where you have lock-in. Once you go in, you cannot come out for 3 years, right? So let me give you an example, a very, very naive example in the sense that whenever you are booking for a holiday and you're booking a hotel, you'll always be careful in booking where you don't have refundable booking or you cannot cancel it, right? Similarly, when you're looking for investments into equities, while in other diversified equity funds, open-ended funds, you can immediately pull out money when there is some changes that are happening in the fund. But in equity ELSS, you cannot do that. So there is a 3-year lock-in. So one should be doing a little more homework while investing into these kind of funds. So what are the few things that you should look at? Stability of fund management team and consistent investment style. So clearly, what you see is what you get is extremely important, and you get for that for 3 years. If you are investing in a growth fund plus an ex fund manager or an ex investment team, that should be there for 3 years, right? It should not happen that 1.5 years people move out, and we have seen many examples where people moving out, people cannot pull out money and the returns suffer. So that becomes a very important aspect for looking into the investments into ELSS. Long-term track record across market cycles. So you should look at market cycles and long-term track record of that fund, maybe 8-year, 10-year kind of track record. And our suggestion always would be that you should not go in for NFOs in this product because you have a 3-year lock-in, and NFOs do not have track record unless you're really convinced about the fund house principle or the fund manager who's managing it and other things and investment philosophy. Third important aspect is that when the government wants you to invest for long term and you are putting money for the long term, it should all very necessary that the fund manager also abides to that long term philosophy. And how could you check that? You can check it through the churn ratios, right? Any churn ratio below 30% is good. Churn ratio is how much the fund manager is trading, right, in the fund. If he's trading very, very highly, so some of the funds have churn ratios of 200, 300%. So this means that the whole of the portfolio is getting churned 3 times in a year, which is very untruthful in the sense that when we are asking investors to put in money for long term, why is the fund manager not taking a long term approach? So that churn ratio becomes extremely important. Second part of the churn ratio is that you pay a lot of transaction cost. When you trade, you have to pay brokerage as a fund house to broking. And when you churn more, the expenses are more, which does impact your NAVs. So lower churn, better it is for long-term investors. Thirdly, a well-diversified portfolio of good quality companies, because you would not like to stuck in small cap companies or very illiquid companies in the portfolio, and the market suddenly goes down and the fund manager cannot exit them. That becomes extremely challenging for the existing investors. So a well-diversified portfolio spread across large caps and mid caps, depending upon where the value is, where the growth is, where the business is good, is always helpful. So these are some of the points one should keep in mind when looking at an ELSS scheme. Now, let me move to Quantum Tax Saving Fund. We are a value-oriented ELSS scheme. So it's clearly the focus is value. Quantum has a philosophy of value investing. So the process remains quite value-oriented. We have a 14-member team which does bottom-up research process, focusing on businesses which are undervalued but have good long-term potential. We are long-term investors. We are not investing for a quarter and a half. We have create a very strong, well-researched mid and large cap portfolio, and with a minimum liquidity filter. And I will go through the process. I have few slides in the process as well, which will help you understand what we are trying to do in Quantum Tax Saving Fund. Integrity filter is extremely important, and our churn ratios are less than 10%. So we have a very long-term view when we invest in stocks. So coming to our process, how we go about doing our research, just a few minutes on that. So we have close to 6,000-7,000 stocks or even more now on BSE NSE listed. That cannot be definitely our universe. So what happens is that we use first filter as the liquidity filter. We want to invest in companies where liquidity is available for the fund manager to buy into and sell those stocks without impacting their values or their prices. So once we use that filter of $1 million average daily trade, we come to close to 450 to 600 stocks, which are in that category. Now, in a bull market, which has been in the last 1.5 years, that number goes to 660. In a bear market, that number comes down to 300, 350. But broadly, you can say it averages out to close to 400 to 450 stocks. Now, depending upon how we perceive the business and the management, we use a very strong governance filter to filter out companies which do not meet us, because we cannot get answers when something goes wrong. So those companies are out. Business models which we believe are shaky and do not have long-term promise, so those go out. And thirdly, definitely governance remains extremely important. Since 1990s, when Quantum was started by Ajit, it is kind of a paramount importance to us. So that goes out. So we are remaining with 200 to 220 stocks, and that becomes a universe. And based upon value, where value lies, we will create a portfolio of 25 to 40 stocks. Coming to our investment criteria, how we find value, our team is a 14-member team. Every analyst and the portfolio manager also does enough research. And the universe is distributed according to the sectors. So we have a team of a person for pharma, we have 2 people for banking, we have a person for IT. Similarly, we have created a large team. Arguably, we run one of the larger teams in the buy side in India, because we want to do our own research. We do not follow what sell side is pitching. So broadly, how a person looks at it is that he or she has an understanding of the sector. Basis that the external environment, the analyst will evaluate the business of the company, how the company is, what is their long-term potential, external environment, whether it is tough, it is very regulatory, or it has an option to grow, its export, import, other things. And then we'll interact with the management and try to understand what are their long-term goals in the business, 5 years, 3-year, 5-year, 10-year kind of goals. And we'll also check whether those goals match up with the ability to finance that growth or the goals of the company. Otherwise, the company will go into kind of leverage, and which we don't want to. We'll prefer companies which generate a lot of cash. Based upon that, we'll judge the company, and based upon that, we'll create kind of an Excel sheet where we have projections for next 5 years at least, and in DCF maybe longer periods of time, and a history of 5 years. And once we have the numbers in hand, we'll use different valuation tools, whichever is the most appropriate to find the intrinsic value of the stock. It could be PE ratios, it could be price to cash flows, it could be EV EBITDA, and we arrive at the intrinsic value of the stock. Now we have the fair value of the stock now, and when we compare it with the price, what we will try to do is try to buy at a discount to the fair value, because being value managers, we want to have some margin of safety of we going wrong or the environmental behaving in different way how we were perceiving it will behave. So we'll have a discount. Ideally, would like to have 40% discount, but in some cases, some high quality companies, the discount is less because they don't fall 40% to intrinsic value in toughest of the times. So that's how we'll kind of decide a buy on the stock. And as we hold the stock, we'll update our numbers every 6 months. And whenever the stock price moves fairly fast and moves above our intrinsic value or fair value, we'll start to trim that. So there are 3 reasons why we trim a stock. If the current price is above our estimated long-term value of the stock, which is the intrinsic value, and it consistently remains there. So we'll start to trim and move out of the stock eventually if the price continues to move up. We have better investment alternatives. So there are times where in a sharp market fall, we get opportunities to buy into companies which are far better in terms of business models. So we'll like to switch there also. So that is also one option that is available to us. And if we have changed view of management or changed view of business, that is far and few between, but there have been few cases in last 10-15 years where we have exited companies booking some loss because our view on the management or the view on the business has changed. So this is the broadly how we go about doing our research. If I talk about current portfolio positioning in the fund, clearly we are positioned towards cyclicals. And if you go across our previous part to profits, or if you webinars, and if you go across some of the newsletters last year, what we have been writing, we clearly feel that India is on a cusp of a cyclical recovery after long kind of slow growth period since 2016. And in this environment, what happens is cyclicals like banks, NBFCs, consumer discretionary tend to have highest earning upgrades because they get a disproportionate benefit from an upcycle in the economy. So clearly our portfolio is positioned towards economic recovery and we are focused on cyclicals. Some of our portfolio companies are benefiting from this whole opening up trade post the COVID, and some of them will benefit as this takes shape further. One key matrix that we are seeing, and if you attended some of our previous presentations, we have talked about that over the last 5-6 years, because some of the government steps and other things, what has happened is that the big are getting bigger, they are getting stronger in the whole business environment, and small is getting smaller or weak, and we have presented data on that. So larger companies are gaining strength and smaller companies are getting weaker. That's what we have seen in last 10 years, and that trend is increasing since 2016, first because of demonetization, which kind of pushed the smaller companies to the brink. Secondly was GST, and third, definitely pandemic. So our portfolio also reflects that, where we have close to 78% of our allocation towards large cap and close to 22% of our allocation towards mid cap. Some of the small cap names most likely will not own small caps, because they tend to be very illiquid in nature, and in the toughest of the times, it's very difficult to exit them. So our portfolio remains steer clear of small caps unless we find liquidity and a great business model. We continue to have stress tests over the last 2 years. We have been stress testing our portfolio in terms of balance sheet strength of the companies, and we find it very, very comforting. And companies have passed on, have clearly surpassed this whole turmoil period with really, really good managements. We have seen some of the IT companies doing extremely well. Even for banks, which is essentially a leverage business, what we have seen is that they are very, very well capitalized. So if you look at some of the banks, they're best capitalized in the last 10 years. So we are very comfortable that in case of a sudden downturn or a fourth wave or a fifth wave or something, what is happening in Ukraine, there is a sudden jerk. Markets could go down, businesses could suffer in terms of profit and loss, but companies have balance sheet to survive that. So most of our portfolio companies have balance sheet to survive that. And we continue to have existing cash, which will be used to add new names in case of correction, like what is happening right now. And we are clearly looking at some of the companies very close to our buy levels, and we'll definitely look into and buy some quality names using that cash. This is our long-term performance track record. Times had been tough since 2016 to 19 for any value manager. That was a tough period. Since post-COVID, COVID fall gave us an opportunity to rejig the portfolio, get some good companies into the portfolio, and performance since that has improved. There was again a rough patch in last September, October, November period, which again because of market dynamics changing, which suffered. But overall, things are looking pretty promising for a value manager. The way things are shaping up in the market as the interest rate and other things increase. Longer you discount the future cash flows, the more sensitive it becomes to a rate increase, right? So we are running a very attractive portfolio in that sense. Our portfolio is valued at 12 times FY2E earnings. So and the index is trading at close to 18 times. So we have a substantial discount. We are running a very attractive portfolio. These are the performance numbers which you can refer to. And now Sandeep referred to our asset allocation plan, generally what we recommend to everyone. So it's a very simple plan, 12, 20, 80, for any common man to understand clearly. What we suggest is that things are very uncertain, and it could not be more uncertain in last 2 years. If anything was pending, now there is a war. So clearly the world is very, very uncertain. So first step in terms of managing your cash flow becomes that you have to have a safety net. So how do we get that safety net? Is first, whatever your monthly expenses is multiplied by 12 is your safety money or safe money that you need to keep separately. That money is not to be invested for taking risk or higher returns. That has to be safely kept either in a very safe liquid fund or a bank FD or a bank account, wherever you are comfortable with. Once you have that money separate, then and then you are left with your corpus to invest. There is a simple 80-20 rule, where 80% goes into equity funds and 20% goes into gold. Now, within that 80%, you will have close to 15% into an anchor value fund. Now, you can use quantum long-term equity value fund for that, or if you want to take advantage of tax benefits, but you are okay with a 3-year lock-in, as we tell always that whenever you're investing equity, you need to be invested for more than 3 years. So might as well take an advantage of tax benefits that the government is giving. And 15% of that 80% should go to an equity anchor value fund. New thematics like ESG, 15% on the Q India ESG equity fund or any other ESG fund that you like. ESG is a new way of investing where more than ROI, return to all stakeholders are important, and these things are getting more and more importance as you have been reading sustainability and climate change and other things. So these companies who are passing those tough parameters, and we have internal team to track that, those companies are expected to do better and gain market share. So that pool of money will reflect that. So you can take a bet on that. And to broad and diversify your equity holdings, you can have 70% into equity fund of funds. So that is a basket of funds. So either if you cannot select yourself a decent basket of well-diversified funds, excluding the value and ESG that you have already bought, then you can get buy into quantum fund of funds, which is a basket of 6-7 well-curated funds by our team of Chirag Mehta and his team. So you can look into that fund, and this gives you a complete basket exposure of equities. 20% into gold. Now there have been new people saying that crypto is the new gold or gold become irrelevant, but over the last 5,000 years, gold has always been there. Nothing replaces gold. And what could be a better example than the year of 2020, where you saw first 3 months when the markets fell 40%, gold just shone, was shining bright. And then in next maybe 8-9 months, equity just went up as liquidity was increased by central banks. And gold did not perform, it was somewhere there. Again, now as the war, there are more news on war, Ukraine and other things, you'll see gold again shines. So it's a very, very good diversification against anything going wrong in the world, geopolitical risks, pandemics and other things. So a good allocation of 20% gold is extremely helpful when you create so this 12-20-80 plan is kind of a well curated plan which you can use. And otherwise, maybe you can talk to your RIA or some planner who can give you customized product. But this is a kind of a ready-made product, not a tailor-made product, which you can use to broadly define your allocation, and you will enjoy. If you keep upon this allocation, we believe that it will help a long way to achieve your financial goals. Now, this is about it. Maybe we can move to question and answers. I think there will be a lot of questions on current markets and other things. So, Sandeep, it would be okay if you start the question and answers.
Thanks, Saurabh, for that brief and information about tax saving. It will be very helpful for people in making choice. So we have some questions around how to select tax saving funds, and we surely also do have questions around the markets yesterday, how they react, how they act also. Yeah. So since we are right now on tax, in fact, can you just brief our investors how ELSS is really good for long-term investing? Because normally ELSS or a tax saving product people see as a last moment option, which ideally should not be, in fact, and people do invest in a haste also. So can it be proved as a good long-term instrument?
Yes. So as I explained, excluding of a lock-in period, there are few things which as a fund manager is good in ELSS when you are looking at investing for long term. There are two things. One is it is into lock-in, right? So in terms of outflows and other things and redemptions, the fund manager has less tension about that there could be outflows. I need to be more liquid or other things. So manage the fund manager, because the investor is also having a long-term approach of things. The fund manager can also think long-term and look at companies which will eventually give reasonably good returns, instead of looking at 15-20 days of NAV performance or 1 month of NAV performance. So it clearly matches what the investors are looking for and how the fund manager is perceiving things. So it's a perfect match. That's the first point. Now, second point on ELSS is definitely tax savings. So it immediately improves your return profile. As I explained to you, just a 12% return on an ELSS scheme of 1,50,000 doubles your money in 3 years, right? Because you have initially upfronted that 45,000 rupees because of tax saving. So that is extremely important from an ELSS perspective. Yeah. And third, after in 2018, when SEBI came out with this ruling of categorization of funds, the fund managers in most categories are quite straitjacketed now. In a large cap fund, even if the large caps, we know that large caps are overvalued and they will underperform, a fund manager cannot go below 65% in a large cap. And you have 101 large caps to play around with. If I remove some corporate governance companies, like there will be 60-70 companies where you can play around with or place your investments. Similarly, in mid caps also, this kind of cap is there. You have 150 companies to invest 65% of your money. And multi-cap, again, SEBI defined how much you can put in large cap, how can you put in mid cap and small cap. So again, it becomes very straitjacketed. So broadly, you have only two categories of fund where fund manager can move around based upon where he's looking at value, right? So one is the tax saving. ELSS does not have those filters or those SEBI regulations of how much to invest where. And second is the flexi cap. So we believe ELSS is a great instrument for long-term investing. Most people think about 3 years. As I told you, longer term periods also great investment opportunity. First, you save tax upfront, that improves your return profile. Plus, you have a great compounding over long periods of time. And as you spend time in the market more and more, it really helps you. And third, one should not miss is that most people tend to be nervous about markets, especially the first time investors. So if you are into a diversified equity fund and you have just invested in January and you see markets falling like this, a lot of people in haste might feel that it's a bad decision and could actually redeem that money, right? Or otherwise, if you have seen a sudden spurt of 10% within a month, they might redeem that money. That option is not available in a well-managed or in an ELSS. So if a well-managed fund you have invested, you have an enforced discipline to stay there for 3 years and more if you want. Right? So these are some of the very great traits of tax-saving funds which people should not ignore while investing.
Thanks, Saurabh. So just ahead of that question only, with the markets correcting, that Saurabh, do you believe it will be a good idea to park money via lump sum in ELSS. The reason why we are asking as lump sum, because in tax saving, obviously your money will be blocked for 3 years of time. So would it be a good idea to block a lump sum idea when the markets are correcting?
Look, if you have not invested till this, if your 150,000 window is still open and market is giving you an opportunity in this fall, I think you should grab with both hands, right? If you have that 150,000 window, if you have already invested, whatever is left, you should put into equities. But if you have that 150,000 left, I think these external shocks or geopolitical risk gives opportunities to invest. People can invest at these points in time, because we clearly feel that as the economic recovery takes shape, we will see earning upgrades in India as well, unless there is a major risk, which we are not as of now envisaging, in the sense of a third world war or NATO attacking Russia and things go really haywire. We are not kind of thinking in those terms. But in a normal risk environment, with ignoring the tail risks, we believe this is a great environment for Indian corporates to perform, to see earning upgrades as demand comes back, as we move ahead of pandemic. Export numbers are extremely good for India, and this is happening after 10-15 years that the economy is being run by, is driven by a lot of exports, not only services exports through IT services, but also product exports. Some of the two-wheeler companies that we are owning are reporting record numbers of exports of their two-wheelers. So these are things which we cannot ignore. Second point is the residential share. Real estate is start to pick up after 8-10 years, and it has a lot of multiplier effect. So we believe for a longer term view, this could be a good opportunity to invest. And because you have just 1 month left to plan your 150,000 rupees of investment, this could be a great time to invest.
Thanks, Saurabh. Since Saurabh, you spoke about the market. Now this is a question from one of our investors, Madhusudan. Now today the markets have recovered 50% of what fell yesterday. So is there no more fear of bear or crash nowadays? Because you see the markets falling and the next day again you see them recovering. Because even in the COVID times, the markets did fell. They fell dreadfully, and the rally was there. It recovered in some time. So does it indicate any pattern, or is there something to read in between the lines?
Look, I think one should not form a view in a day's movement. We should not form a view that the market is going down or going bonkers because the markets fell 2,700 points. And we should not be overly bullish because market recovered 1,500 points, right? So taking a day's view is not helpful for any investors. What we feel is that tracking economic growth and corporate growth is extremely important. And that should be the litmus test of believing where the markets will go. Because if you look at long-term charts, eventually the market tracks this. If you look at only Sensex, and since 2002 we have that chart, not in the this presentation, but historically when we have presented, we have that chart. Since 2002, 2003, Sensex is very accurately tracked the Sensex earning growth, right? So it will follow earning growth. And as of now, we don't see risk to that cyclical recovery. So we believe that cyclical recovery is in place, and when earnings growth happen, a market maybe with a lag or a lead will follow that. So that's the test that one needs to follow. Secondly, what happens is there are multiple technical factors, and with this whole FNO thing, now I was just looking at one data point. If you look at the total open interest in FNO in India, the futures and options market, it is 16 trillion rupees. Right? Now, 16 trillion rupees is 16 lakh crores. Right? This is bigger than almost the balance sheet size of HDFC Bank. Right? And this number was 8 trillion rupees maybe about a year ago. So these technical factors, and look what happens. If the market goes 5%, and let us assume that FNO stocks goes down by 5%, anybody who's holding an FNO position will have a mark to market to fill, and that consolidated mark to market of 16 trillion rupees will be 80,000 crore rupees, right? So there will always be these technical factors which will market on a daily basis will put the market here and there. But over a period of time, it will track your earning growth. So as wisely said by Warren Buffett, in the near term, it's voting machine, and in the long term, it's weighing machine. So just track those earnings and sit tight and look long term.
Thanks, Saurabh. Saurabh, one more question on the market notes, and then we will again have the other questions on the ELSS part.
Yeah.
Meantime, if you can just switch to the screen on 122080 also.
Yeah, sure.
So an extension of the same question, it is from Madhusudan only. Now he has observed that our equity funds like both quantum long-term equity and ESG fell in tandem to the index. For example, yesterday markets were down by 4.8%, and our fund and the fund's NAV, quantum long-term equity fund and tax also, which we do not hold the toppers like Reliance or Adani in the index, and we also do not replicate the index or mimic the index. So how was the downside protection managed in the fund, or the fund manager's action to save the fall? Because if it goes reverse up in that case, maybe will the fund rise at the same levels, or do we fall with the index at the same level?
Yeah.
How do we look at the numbers?
Sure. So I'll give a little longer term answer over here, a bit more long answer over here. First is a single day move does not repose faith or depose faith on a strategy. So one day change has a lot of technical factors. One of the technical factors which we have faced historically also is that, as you would know, we run a very liquid portfolio. Now, a fund manager who is not running a liquid portfolio and the market is falling and is facing a redemption pressure, the first thing that he will sell is a liquid stock, right? So it is always that in the initial fall, those liquid stocks tend to fall a little more. If you have seen even yesterday's fall, etc., even stocks like very blue chip high quality names like HDFC Bank fall 5.5-6%, right, which we own in the portfolio. Similarly, ICICI Bank. So what happens is, because of these technical factors, there could be a day or two where we also fall, or maybe a week where we fall more. But we also looked at these numbers, whether the portfolio is behaving the way we want it to behave. Now, I have some data points. Now, if you look at on a YTD basis, quantum tax saving fund is down minus 6.3%, which is fair. And the ELSS as a category is down 8.31%. This is as of yesterday, right? So clearly we believe the strategy is playing out the way we want it to be. So it is falling less than our peers. Now, if you look at the benchmark or BSE 500, the broader benchmark, I think it fell by 8%, 8.2% again. So broader benchmark, we have outperformed. BSE 200 has fallen by minus 7.5%. And BSE mid caps has fallen by 11%, and BSE small caps has fallen by 14%. So we believe QTax has fallen by, as I told, minus 6.3, and QLTBF has fallen by minus 6.5. So 1 or 2 days or a week, there could be technical factors, but we believe broadly, actually, over the last 2 months since this correction has begun, the portfolio is behaving the way we want it to behave. And if the market correction continues and actually spreads to more illiquid names, you will see this phenomena play out more and more, because that will be the point when the liquidity goes out and there is a redemption pressure, and stock prices will fall much more on illiquid categories of stocks. So we believe the portfolio is performing the way we want it to be, but a day or two can be an aberration because of technical reasons. So it will be very difficult to take a call on a strategy or a style based on a day's return.
Thanks, Saurabh. Yeah. So we'll again turn to some ELSS questions.
Sure.
Now, this is a question on ELSS only. Do you suggest an SIP in an ELSS fund or a one-time investment in an ELSS fund, just keeping in mind the ATC benefit for the investor?
Absolutely, we would suggest an SIP. Start in April, 12 months. So 1,50,000 divided by 12 is your answer. I think that's the best way. And every year you invest and let it continue. Every 12 months that you will get that tax relief. So SIP is always the best vehicle for any person who wants to invest in markets but do not have time to spend in the market, or the tools to ensure, because whatever we say, humans are not rational, right? There will be greed and fear in our mind. We will be fearful, we will be greedy. As an institution, we have created some tools to stick our neck out and buy, which we do. Unfortunately, most of the investors won't have that kind of courage to go ahead and invest when the market falls like 9 pins, like happened yesterday. People will freeze. So average it out. I think SIPs would give you a very decent returns. So if the best returns from bottom is 17%, and from the top is, we did that exercise. I'll tell you one more example since we are talking about this. So if you had invested, I did this about 3 months ago. So it could be slightly dated, but broadly you'll get an idea. If you had invested in Sensex in January 2008, which was the peak of that bull cycle of 2004, 5 and 2008, the markets were 21,000. Till last year, you made a return of close to 11.5 or 12%. If you had invested in 2009 March, which was the bottom of the market in that whole fall of Lehman Brothers and financial crisis, you would have made 17.5, 18% return. Both these scenarios are extremely difficult scenarios. But if you had done an SIP somewhere in between, you could have generated close to 14.5 and 15% return, which is a fairly good return, right? At 15%, you double your money in 4.5 to 5 years. So let's target that. Let's be fair to ourselves, and that should be the number one should target.
So Saurabh,
yes,
another part there. Yeah. So can I invest my entire corpus? Entire corpus means to the limit of 1,15,000 and ELSS fund. What do you advise for the benefit of ATC and also from my investment objective?
Yes, so definitely. So as I explained in this whole asset allocation strategy, if you're looking at filling that 80% bucket and you have a longer term view, you should invest in equities. If you are closing into retirement, I would not advise that unless you have a lot of wealth and you can take care of market volatility, or your a tailor-made financial planner tells you to do that. But on a normal plan, on a kind of a ready-made plan, if you have 10-15 years of view, why not take advantage of the tax benefit and increase your returns and get benefit of that? So we believe that definitely that whole like 1,50,000 window can be used for ELSS every year. And if you have to invest, let us assume that your asset allocation strategy tells you to invest 5 lakh rupees every year in equities, right? Of that 5 lakh, why not invest 1,50,000 through an ELSS? Enhance your return, save your tax, right? And let's 3,50,000 into a diversified equity fund or an FOF fund where you have easy exit plans if you require money. Right? So on a T+2, you'll get your money. Maybe T+1 now, I'm not sure. So definitely you should use that. Government is providing that. Now government is not helping the middle class by increasing slab for 7-8 years. So whatever opportunities are there, you should use it to the max.
So there is a question on the churn ratio. Where can I find the churn ratio of the fund? This is a question from Himanshu. Himanshu, you can find the churn ratio or the portfolio churn ratio on the fact sheet. If you go to our website and download the latest fact sheet, you will find it on page number 14. In fact, I think the current churn ratio or the portfolio churn ratio will be for us will be around 8.09 for the last year. Saurabh, for the benefit of other investors also, can you just explain what's the churn ratio? How is it also important?
Yeah, so churn ratio, simply speaking, is buying and selling in the portfolio. Right? Higher the churn means the fund manager is buying and selling more. A 200% churn means that 2 times the portfolio has completely churned within a year. Now, our bet is that what you see is what you get is extremely important. So if somebody is promising you give me money for 3 years, think long term in equity markets, and you give the fund manager the money to manage, right? Now, that is the promise given by the fund manager that you give us money, we will manage it for you, and you have long term view. Now, it will be very bad from a fund manager's part if he asks a promise for a long-term investment, but he himself churns 3 times the portfolio, right? Eventually when he picks up stocks. Right? So we believe lower churn is important to align. So especially on the ELSS side, what we have seen is that you have a 3-year lock-in, and similarly, you want to invest for long-term because you have a 3-year lock-in and hopefully for more. But and the fund manager, because of the churn, will reflect that he's also having a longer-term view on stocks. Right? So this is a match between your thought process and the fund manager's thought process. This is the first part. Second part is the brokerage. Now, when a fund manager trades on the portfolio, it is not for free, right? There is a brokerage to be paid to these institutional brokers, which could be ranging from 8 paisa to 10 paisa or whatever the rate is, right? More you churn, more you pay brokerage. And who pays the brokerage? It is not from the PN. But no mutual fund will pay from the PNL. It is from the NAV. So why pay more brokerage? The work is of the fund management team is to identify good potential businesses for long-term investment, and he should be doing that instead of looking at what the quarterly numbers could be for next year for a company. Let me make that 10%, then again move out, then again make 10% minus, do a stop loss. I think, and that is a problem. Secondly, scalability also becomes a problem. It is easy to trade in a say 200, 500,000 crore portfolio. But as the portfolio sizes increase to 10,000, 15,000, 20,000 crores, the fund manager won't be able to replicate that kind of returns. And we have seen in multiple funds where the fund sizes, as the fund size increases, performance tends to take a backseat because he cannot churn the portfolio at 32,000 crores for a meaningful position of say even a 1%. He has to take 320,000 crores of, 320 crores of position. For a trading perspective, it is not easy. There are not many liquid names where you can do that. Right? So these are some of the things that you know when you look at the churn ratio, and why that churn ratio is extremely important. Yes, if somebody wants a portfolio like that, he loves the fund manager to trade, that's your call. Right? That's anybody's call that, okay, I want my fund manager to trade more. I want a trader fund manager. That matches your philosophy, perfectly fine.
Thanks, Saurabh, for putting that in very simple words. Yeah, Himanshu, we will get the tax saving churn ratio, the portfolio turnover ratio in our fact sheet. It's on page number 14.
For that matter, Himanshu, every fund house has to report that churn ratio. In every fact sheet, you will find that, and you can have a comparison.
Will be around 8.07 in the last 1 year. So sort of going ahead, there are around 5 questions from the same investor. Now, this is around our asset allocation. Yeah. Now, can you confirm the allocation percentage ages for various asset classes? Because we do understand that the allocation may change from a certain age. Maybe someone at a 30 years age may have a different allocation. Someone at the age of 60 who may be retired after may have a different allocation. So can you confirm the allocation percentage for generic age groups or various age groups?
Yeah, so broadly, this 12, 20, 80 is broadly for a typical person who is like a 30, 35 years age, and his long-term financial goals like child's higher education or child's marriage or his own retirement is close to 20 years away, 15 to 20 years away. Right? So this 12, 20, 80 works preferably for a person who has earning a lifetime of more than 10, 15 years. Eventually, as you get past close actually to your retirement, your plan needs to change. Right? From that 80% equity allocation, as you come closer, you have to move it to a multi-asset product, which is a little less risky. And as you further reduce, you will move to a debt product, which is very safe. And if you understand that, then only, and then maybe eventually move to a liquid product. So slowly, as your earning kind of age reduces, that should be the path of reducing your equity allocation as well. And as you close to your retirement, that at that point in time, your equity allocation risks should be equity allocation should be on the minimum side, unless you have wealth to back it up. So basically, what is the reason of reducing equity as your earning life reduces is simple, right? Let us assume that you have invested X amount of money, and equity, while my perception on equity is that it is not risky, but people perceive otherwise. If you lose money in equity because you put in money, markets fall by 10,000, or and you panic and you book loss, right? People do that because, as I told, people are not fully rational, and there is nothing wrong in that. What happens is that if you book loss, you have a good 10, 15, 20 years of your life left to make up to that loss and eventually lead a good life or achieve your financial goals. If you're just 3-4 years away from these big financial goals, and you make a loss on equity portfolio, and you panic, or whatever happens to your equity portfolio in that volatility. And you, because the market can be irrational, it can be suppressed, as we've seen in 2008. For 1 year, it was kind of undervalued. In 90s, it was like 4 or 5 years, it was undervalued. So what happens is then there will be a problem, and your financial goal, achievement of your financial goes into jeopardy, because you don't have earning life left to recoup that amount. Right? So that should be the broad trajectory of your financial goals and achievements and allocation.
Yeah, thanks. Saurabh, will this allocation percentage be changed as geopolitical changes come up, or there is economic data that may come in, like interest rate changes, the GDP number changes, or events build up? So how can you explain to our investors how this model is built for an all-weather portfolio?
Yes, so I believe that it's clearly made for an all-weather portfolio. So what happens is that these geopolitical risks will come and go, right? What happens is that you have a gold allocation of 20% to take care of that. I think for that long-term compounding, you need a large equity allocation. Yes, you should stick to that. Now, let me give you a little more data on India. Now, India in last 40 years have grown by 6% CAGR. On a real GDP growth number, if people understand GDP, 6% is the real GDP growth X of inflation. Nominal GDP growth rate with inflation has been 13-14%. And as of now, we don't see any reason to disbelieve that in next 15-20 years, India will grow by that number. So if your nominal GDP growth rate, just a moment. Sorry about that. Somebody was at the door. So what I'm trying to say here is that so if the GDP, nominal GDP is growing at close to 14%, the large corporates revenues will also grow in line of that. So 13-14% of top line growth for large corporates or well-managed corporates. And let us assume that they are able to take price hikes and their margins remains the same. The earnings will also grow at 13-14%. And as a fund manager or as an astute investor, anybody else can create a portfolio of these companies who can consistently grow higher than the GDP growth rate, 14-15%, or gain market share. We don't see a reason why a portfolio returns from equity should be less than 14-15%. So 70% of your portfolio will generate that kind of return, or 14-15% kind of return over long periods of time. And you have 20% allocation to gold, which gives a great diversification benefit in times of geopolitical risks or pandemic and things like that, which balances out equity risk. And you have 12 months of cash flows to save in case you have a job problem or a health problem. So I think this asset allocation should take care of most of your problems. Unless you have very specific problems, which maybe your product or your asset allocation can be tailor-made. There could be issues like specially abled person or some other issues within the family and other things where you require a specific asset allocation tailor-made. But broadly, for anybody, any earning member who is 30 to 35 year age, this, I think, long-term allocation should work fine for him.
Also, Saurabh, can you help me with how much cash component ELSS, so tax saving fund, holds? What is the expense ratio and what is the AUM as on date for tax saving?
Yeah. Yes. So as you would know that quantum tax saving has a very mirror portfolio quantum long-term equity value. So as of now, cash levels is a bit higher than quantum long-term equity because the cash goes in different funds at different times. So here the cash would be close to 9.5% now in our fund, in quantum tax saving fund as of now. We are looking at opportunities in this correction to deploy that money, and hopefully we should be able to get some good names. Very close to buying a few. Current AUM is close to 104 crores, but since the portfolio is mirror image, I think put together with quantum long-term equity value, the AUM is close to 1,000 crores. slightly less than that. So depending on where the market. So that's the AUM of the fund right now. Expense ratio is close to 1.2% on the direct side.
Yeah. So the expense ratio is 1.29 on the direct side, 1.79 on the regular plan. Yeah. So going at Sorbh, so what's your choice? I think you gave the answer for this, but if you can reiterate, a lump sum or you start an SIP. Yeah.
Look, so if you have not invested yet, lump sum, and I think Mr. Putin has given you a great opportunity to put your lump sum, and March is the deadline, so better you put your money over there now. And from 1st April, ensure that you start an SIP for long. And 1,50,000 divided by 12, it's a great number to have as an SIP.
Right. And just for benefit of investors, along with an SIP, if you have a lump sum amount, you can always park at the start of the year if you have in the liquid, and you can do a switch from that. So if you want to invest around 1,50,000, you can say at 12,000 rupees per month from your lump sum starts going on also. Now, this is another question. The investor is from Noel Das. Now he has already exhausted his 1.5 lakhs tax benefit bracket through his investment options, various investment options. Now, still, does a ELSS fund will make sense for me?
Yes, I mean, it inculcates a discipline. So you can choose a ELSS plan for quantum perspective. If you have that inbuilt discipline and you have already exhausted that 1,50,000, you can get into quantum long-term equity or quantum tax saving fund. The portfolios are mirror image. Right? But as I told you, this self-discipline and plus long-term horizon for the fund manager, plus the flexibility of investing into any kind of caps where value lies or opportunity lies. These are some of the unique traits of this product, which generally people do not discuss. So if you can live with that 3 years of lock-in, why not? I think it's a great product to invest in.
There's a question from Mihir. Now Mihir has been an investor with us. He has been now he writes that he has been attending our physical path to profits, and also most of our online webinars, and he does really like our investing concept since beginning. Hence he has some questions on the allocation of QMA, because initially we were only with quantum long-term equity fund, then we had other funds, and then we built a solution around it. Now the question is that we have been speaking about solutions. Now people do like solutions, but the allocation right now, the allocation shows only QLTF is 20%. Now that seems to be a comparatively less for an investor who has invested into quantum long-term equity fund since inception or at the early stages. So what's your view on that? Is it a limited return issue, or is there any particular reason, or why are we suggesting fund of fund as the major part of it?
So this is a typical plan for anybody who does not want to stick to a philosophy, right? So internally, maybe me and my colleagues and even Ajit, this ratio could be totally opposite. Right? So it could be 80% into quantum long-term equity for me, Nilesh, some of our colleagues, Subbu, Ajit, and all. But what we say is that because we understand that value is a style, there is a style risk, right? And we have seen that between 2005 to 2007, and we have seen this in 2016 to 2019, where the style really underperforms. And people who do not have a lot of understanding on value, they could panic over here. And that's why we suggest that, okay, spread your basket. You have 15-20% as an anchor on quantum long-term equity value, which over a period of time will generate that 14-15% for you, which doubles your money every 4 years, 4.5 years, and quadruples your money in 8 years, right? Which is a fair game. But then really there could be anxieties for 2-3 years period of time. So we always advise people, okay, why don't you diversify? Now, fund of funds is something which Chirag curates very nicely. He picks up some large caps, some mid caps, some not necessarily a lot of small caps, and he curates that portfolio to align with that. Now, if one is more comfortable with value style and can live with this 2-3 years of underperformance and likes the style and philosophy, these ratios are just a suggestion for somebody who don't want to live with that style risk, right? To reduce their style risk. as Saurabh, is perfectly all right with the style risk. Nilesh is perfectly all right. Maybe Sandeep is perfectly all right with the style risk. But Himanshu, you might be comfortable with that style risk, but maybe others are not. So this is the reason that we suggest these allocations.
There is a question from Mr. Prasad. Now he's left with around 30,000 to complete his ATC. The maximum it is 1.5 lakhs. So he was asking, can you suggest some ELSS funds on lump sum? So Prasad, we will not be able to comment on other funds, in fact, but if quantum tax savings fund suits your needs, you can surely look at quantum tax saving fund. Anything you want to add, Saurabh?
No, that's the perfect answer, Sandeep. We are unable to talk about other funds. You are the best judge of that. We are presenting what we do, what our style is, and how could you select one of the better funds. And eventually you have to take a look and take a call over there.
There is a question from Himanshu now, since investors are now investing in mutual funds. Can you just brief them about how does the long-term capital gain work and how it might dent the returns? There will be a slight dent, but how much it is?
Yes, so it's 10% without indexation, simple, right? And if you have been, and with a kind of, with a period in investment more than 1 year, less than 1 year, it is short term and it will be taxed at higher rates. But if you have invested for more than 1 year and you have capital gains less than 1 lakh, it is tax free. More than 1 lakh, straight away, whatever gains you have made, 10% will be taken away from that. But since this provision was introduced in Jan 2018, any profits made prior to Jan 2018 is grandfathered. So your cost will be what the price of the stock or the NAV of the fund was in 31st Jan 2018. So that grandfathering clause is there. So it's pretty simple over there. So if you have made like 2 lakh rupees as capital gains, so for holding it for more than 1 year, 1 lakh rupees will be tax free. For next 1 lakh, you have to pay 10,000 rupees.
So for a minute, if now this is a question from Shakni Kittu. Now for a minute, he imagined the investor doesn't want to invest for tax saving. There is no tax saving benefit for a minute. Just there's no tax saving benefit. Still, you will suggest to invest in a ELSS fund or other equity funds, and the reasons for that.
Yes, so as I told you, I mean, there are few traits which are specific to ELSS. Right? Now, if you like a certain style, you are comfortable with a 3-year lock-in, you don't have access to that money, or you know that you are not disciplined and you tend to kind of get nervous with market moves and you want that enforced discipline, ELSS is a product that you can look for if you're okay with that 3-year lock-in and without tax benefits. I think actually for first-time investors and people, look, there are two things: ability to take risk and intent to take risk. Now, people have a lot of intent to take risk, but ability, people do not judge themselves nicely. Right? If you have put 1 lakh rupees and tomorrow that 1 lakh becomes 90,000, people will surely panic. And if you go back in history and have you panicked like that and you want that enforced discipline, why not go through an ELSS is my idea. If you like a philosophy and you can hold on for 3 years, why not going for a kind of ELSS product? So that would be my pitch, that even if you're not getting tax benefits, but if you are looking at those things and you look at style and you know that there is a flexibility available for the fund manager, and fund manager is doing what he's promised to do, having a long-term approach, having a low churn, then you should look at these aspects. And X of that lock-in period, it's like a typical diversified equity fund. So why should it be excluded when you are making an investment decision, if you like the fund and like the philosophy?
Thanks, Saurabh. A bit of question now away from the ELSS, in fact, and we were expecting this would come to you, Saurabh, in fact. What has happened in the NSE scam and the Himalayan god there?
Look, it is disappointing. About 4 or 5 years ago, before that co-location scam, we always believe that BSC is kind of group of people and NSC is thoroughly professional. The kind of products that they've introduced, kind of professionalism they brought in since 1999, their whole risk management mechanism, if you see, could be arguably one of the best in the world, right? In terms of how, as I told you an example, 16 trillion rupees of outstanding F&O contracts in India in value terms. In volume terms, we are one of the highest in the world. All this in NSC, and their servers, their engine works just perfectly fine. Within all that, having these cases is not good. And it started with co-location, right? It was clearly a kind of stab on the back of the investors, right? Where few of the kind of brokers were getting benefit and their trades were executing nicely. But thankfully, this is now taken care of, and I'm sure the regulator will set an example that these things do not happen. As you see, there were enough scams in the equity markets in initial years in 90s, the early 2000s. But post that, the SEBI has done a wonderful job in tightening things up. And we as a mutual fund know how many audits we go through, how many circulars we receive from a SEBI. So I think now SEBI will also tighten the noose on stock exchanges, and that should eventually be helpful for the investors.
Thanks, Saurabh. This gives us one more reason to stick to the asset allocation. What do we suggest to people? There will be wars, there will be COVIDs, there will be an Himalayan God also. So stick to your asset allocation, which is on the screen. Saurabh, another question from us now. Quantum has been there. Now it stands for trust. A lot of people have trusted us with now. And now the biggest trust normally comes in with a pension plan where people trust us with their annuity money. So any plan of Quantum Mutual Fund coming up with a pension plan or an immediate annuity plan?
I do not know of a plan. There are discussions that keep happening, but I think some of these bigger players bid very aggressively, so I'm not sure that in the near term we are looking for such a plan. At least I don't have an knowledge of this. Anytime in the near future, I don't see that coming from Quantum Stable.
Okay. So just for an option, in fact, so if somebody wants to have an annuity or a pension, so what would you like to suggest? Would you like to suggest something like a multi-asset or liquid? What would you like to suggest?
Sorry, Sandeep, I missed that last line of your question.
So if somebody would like to keep some pension money with us, or would like to have an annuity for them or a regular income, Now I have worked hard for my life. I earned whatever portfolio I have to develop. I have earned that corpus now. I have grown that corpus now investing. Now I want to invest that corpus and would like to have an annuity or a pension for me per month coming in. So what would you suggest?
So within our product stable, I think something called a Quantum multi-asset product is very, very suited for you, which is kind of somewhere between an equity product and a fixed income. Very wisely managed and very strictly mandated by certain criteria that are created by Chirag, and it tends to outperform the FD returns, but you should not benchmark it to equity returns. So we reduce the risk of equity, but with some kind of solutions that he has created, or framework that he has created. He tries to balance between equity and gold and debt, and that gives a very sweet return of higher than FD, which much less risk. So that could be one product that one should look at. And as I said, if you don't have a lot of wealth to back with, then maybe going into equity doesn't make sense. Having a multi-asset product and a liquid product, which will be more helpful, where the returns would be less, but I think the preservation of capital is paramount at that age.
Thanks, Saurabh. Now, sir, there's a question from a person now who has retired now. He wants to invest around 1.5 lakh in ELSS. Now, without any brokerage, obviously, if someone wants to invest without brokerage, you can go for the direct plan. But they would like to know the product more, you can surely talk to your advisor and go for a regular plan. But the question is here again, at the age of retirement, should I look at an ELSS plan in an equity? with a whole of about 1.5 lakhs for that year?
If you have tax liabilities, if you are into that tax bracket of more than 20% or 30%, if you want to save tax, the simple answer is yes. That's one. Secondly, if your lifestyle and your wealth allows you to have a lock-in of 1,50,000 rupees, where you are not allowed to withdraw that 1,50,000 rupees, then you definitely can invest. There are enough retired people who have higher slabs of taxes where people invest in ELSS plan, just like a salaried employer or an individual who is earning right now. So why not? So if you can live with that lock-in and you can, if you have taxable income, you should definitely invest in ELSS. But you should have that wealth, right? I again say that you have to have that after retirement. You have to have that wealth to back on, right? When you are looking at equity returns, it's equity are volatile, but they give you superior returns, and longer you hold, they're not as risky as it's perceived or made out to be because of the volatility. So 2,700 points down, 1,500 points up. On a day-to-day basis, it might feel so, right? But on a longer term basis, it is not so risky, but again, it will test your intent and ability to take risk because of volatility. So please be careful if you are investing post-retirement.
Thanks, Saurabh. Saurabh, Firoz Sayed, now he wants to answer you two questions. Can you recommend 3 books to read on investing before dying? What he says, with specializations on investing with technicals, etc. And second will go on an investor psychology. On investor psychology.
So technicals, I have not read much book, but one latest book which is kind of making waves is The Psychology of Money, which is a great book to read. It really talks about being rich and being wealthy. It's a very nice book to read. Why becoming rich and staying healthy, how these are two different things. So I think this is one book that you can read. And besides that, definitely there will be enough books, self-help books that you can go through, but this Psychology of Money will help you both in terms of psychology, in terms of behavior aspects and other things, and also from a perspective of how to kind of look at your portfolio at different ages and other things. So this is one book that you can definitely look at.
Sure. And Firoz, sure, we will consider your last request. If you have, I will have your surely send you over the book. Yeah. This is a question from again Himanshu. Now they would like to see quantum on the NPS side on the national pension scheme. We as a company don't reflect that. Any views on this, Saurabh?
Yeah, as I told you that NPS earlier were bid very aggressively. Now we've all heard this, that there is some element of not so what should I say, a great transparent mechanism of choosing that NPS player, and aggressive bidding that happens, plus non-transparent way of choosing those NPS providers. So that is the reason we have stayed away from that. But I think last 6 months ago there have been some changes in terms of the authority, the regulatory authority has allowed a decent amount of expense. They've increased expense ratio. They've allowed brokerage to charge within the NAV and other things, which are healthy for a longer term growth of that product. So if all things are fine and we have that transparency of how these licenses are issued and other things, then we might look at it, but it's not in the near future. Not that I know of.
Thanks, Saurabh. And thanks, Himanshu, for asking that question. Also, earlier we had a question on annuity, because when people trust us the money with their pensions and annuity, it feels really great that the trust that they have with us. Thanks, Himanshu, for thinking that content should be a part of the national pension scheme. Yeah. Saurabh, last 2-3 questions for the day. How does ELSS as a product compare with PPF in an NPS or an ULIPs also?
No, I gave 3 comparisons, right? So 4 parameters. Now PPF is tax-free. It gives you 7.1% return and assured return, right? So if you are averse to taking risk, you don't want volatility, which makes you not sleep at night, PPF is a perfect thing for you. But what happens is it will always have a hole, create a hole when you creating a portfolio for longer term, because inflation will kill your growth. You nominally you are making that 7%, but if inflation is also 7%, which can be most lot of cases, especially inflation of your consumption basket, it can be more than 10% because it includes education and other things. You're actually losing out on money. So if you are 30, 35 years of age, I would suggest you take your chance and you look at this equity product, ELSS. I think if you don't want to commit whole 1,50,000, at least start with maybe a 25,000, 30,000 of these kind of things, and then once you get comfort, spending 3-5 years, okay, you're getting comfort that your money is not lost out, then you maybe want to increase, you can increase. But at 30, 35 age, or maybe even 40 years of age, going into a fixed income product, I would suggest an ELSS is a better option, and it perfectly fit your financial goal for long term, right? If you want to achieve those financial goals, you need your money to grow at 13-14%. And equity is the only allocation that you can do for that kind of money return generation. So allocation to equity becomes important over there. Coming to ULIP again, I always find ULIPs a little more, less transparent. There is an insurance, there is an expense ratio which can be a lot higher. There is a surrender value element. 3 years you get 0 surrender value, and a lot of other things, right? So my personal suggestion is to keep insurance and investment separate. Right? You have a term insurance, that's clearly an insurance. You know how much you are paying out and everything. For investments, let's go for mutual fund. You know what you are getting, what you are paying, what is the lock-in, everything is extremely clear. No concept of surrender value, no concepts of after 5 years, what could be the expense charge. And most people have really bad and nasty experiences on ULIPs, because after 3-5 years, because of some reason they want to withdraw, they suddenly realize that 60-70% of their whatever they have paid, and this used to happen a lot earlier when there was no rules regarding that. 60-70% of their premiums that they paid for 3-5 years is gone as kind of commission to distributors. Right? So I find it a little more opaque. It could be my bias, but I think you do a little more homework on ULIP. My advice: have a clear basket. Okay, I have a 25, 30, 40 lakh rupees of term insurance. That this is the premium. Rest all the amount goes into my ELSS. And I know what the expense ratio is. I know there is a 3-year lock-in and what I can get after 3 years. I think there is much more clarity when you look at ELSS versus ULIP.
Thanks, Saurabh. Just last 2 questions in fact, and there's a question from Mr. Vijay Raghavan. He wants to invest in quantum products. Please give the website. So I will type the website in the chat. It's quantumamc.com, Mr. Vijay. We have a beautiful invest online section. It is very user friendly. You can go on quantumamc.com and directly invest if you wish, since you want to invest directly. Yeah. So Saurabh, is a performance a criteria to select a good ELSS fund? I will also add the second question, and it be quantum tax saving fund being one of the oldest tax saving fund. How does it differentiate itself from other tax saving funds?
Yes, performance is important, but you should look performance in the light of what style it's being managed with this moment. And definitely having a longer term view on the performance. One should not take a myopic view on performance, because environments can, if a fund manager is sticking to a style and the style goes out of favor, there could be periods where the fund manager underperforms. But you should know that the fund manager is sticking to a style, and that style, when it comes back in vogue, then this whole underperformance is taken care of. So having a longer term view on performance is extremely important. Performance is important. We cannot ignore performance, and that's the reason people are investing, right? So, but having a more holistic view on performance is more important. If there is an underperformance, why there is an underperformance? Did the fund manager promise that this is the way the fund will be managed? And is he managing in a very similar way? If the fund has promised that it will be more large caps and underperformance is because the mid caps and small caps have performed better, then you should be ready with that kind of thought process. Okay, this is the reason I invested into, and this is the reason performance has not come, or it has come. Right? So going right for right reasons is extremely important in a fund, and you should have that kind of a magnifying glass to look into performance. That becomes extremely important, and that adds to your comfort. Right? it's a long-term relationship of the investment team and you, right? So more comfort in each other is definitely helpful. Now, yes, quantum tax saving fund is one of the oldest tax saving funds that we launched in 2008. It was launched as a wraparound for quantum long-term equity value fund, as people who wanted to have tax benefit could put in money, have that tax benefit. We have a very similar portfolio of quantum long-term equity value, and it essentially performs what it's supposed to do. It's a wraparound under quantum long-term equity value fund, managed through a value style, very consistent team, very consistent style of managing, and performance over a cycle reflects that. So I think true to ourselves, we are doing what we promised to do at the inception, and that will continue over a period of time. And you'll see that over longer periods of time, this whole style philosophy makes your return a lot more comfortable, and you will enjoy the fruits at the time when you require it, when you achieve the financial goals. So I believe this is how. So there are 2-3 specific factors I'll tell you about ELSS when I was looking at the peer set. One is we tend to look at liquidity very, very seriously. Some of our peers do not look at liquidity. We tend to stick to mid and large cap. We don't venture into small caps because those become illiquid and very risky. So that's a second differentiator that we have. Thirdly, we believe we are the only ELSS which is following a value philosophy. So that becomes extremely important. And integrity screen and other things are also totally kind of inculcated into the way the product is designed. So these are 4 or 5 factors which is unique to quantum and to quantum tax saving fund, which clearly differentiates from us from others. And this you have seen in last 2 months, right? In 2 months, while the category is down 8.5%, we are down 6.3% because we have steered clear of something.
So I think that was the questions for today's webinar. Yeah, thanks Saurabh for giving your time and for answering all the queries for us. There may be some questions people would still like to ask. They can write to us at customercare@quantumamc.com. Really thankful for all of you for giving your time. We would surely like to keep these sessions going on, and till the last question is answered. Any question if you would like to get answered from us, you can please write us at customercare@quantumamc.com, and we will ensure that it comes back to you. And as was also mentioned in Mihir, as you mentioned, you liked our physical PT path to profits coming in. Soon we will be coming to your cities also soon. Yeah. So thanks, Saurabh. Thanks for your time today evening. All investors and all, please, we really appreciate the time you gave today. Thanks a lot. Thanks a lot.
Thank you, Sandeep. And one more point I'd like to highlight over here. Sorry. That please do follow us on Twitter. Please do subscribe to our YouTube channel. We have plethora of very, very knowledgeable videos which will help you understand the markets, how we think over different market cycles and everything. And these are not biased about getting more followers or becoming influencers. I think it's really a plethora of wealth of knowledge that is available on our YouTube channel. So you can visit and you can understand, and then you can be more prepared to ask some questions that you might have on what we were thinking at that point in time, or why we said something at that point in time. And also follow our Twitter account, which have our updates about our newsletters and everything. And I also strongly recommend to read our monthly newsletters, where we update people about what we are thinking about these new things that are happening around, and why or why not it will impact the portfolios. Strongly recommend to people to read and view us. Thank you.
Thank you. Thanks a lot. Thanks a lot. Thanks, sir.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.